We're going to continue our conversation with BlackRock's Rick Rieder in just a moment. But first, I want to get to David Tweed in London, who's been combing through some of those comments and the headlines. David?
Interesting what he had to say just there on premature to start talking about exiting the non-conventional measures, because I was just in Chernobyl in Italy on Friday, where I spoke to ex-ECB chief economist Jürgen Stark, and he was saying that it's time for the European Central Bank to start thinking about these exit measures. But then again, he is also German and he's from that very hawkish school. Certainly something that Mario Draghi indicated he's not. I want to return to inflation very briefly as well. He's mentioned that there are upside risks prevailing in 2012, largely because of commodity price gains, but he also said the outlook, inflation risks are broadly balanced, and he predicts that the inflation will actually come back to below the 2% target of the ECB at the beginning of 2013. That's quite an important statement. Certainly shows what Mario Draghi's belief is on the outlook of inflation. Also putting it into the context of what's happening in Germany at the moment, where there are wage rises going through and even signs of rising property prices.
Okay. All right, David, thank you so much for going through and revisiting those comments from Mario Draghi. And I want to bring back Rick on this because, you have been obviously investing in Europe. And I know one of the things we talked about before was Italian debt that you've been buying. It's gone up. It's done well for you, hasn't it? Is it time to take your money and run?
Yeah, we've pared back some of the exposure. I mean, it's run, the LTROs were really powerful in terms of for Spain, for Italy, and it's run, a few hundred basis points in the front end of the curve. So it's hit targets that we were looking for in terms of where we thought upside was. So we've taken some of the exposure down. If you look across Europe today, though, it's still probably the best exposure you could have. We certainly like Italy versus Spain. So we still have exposure, but we've pared it back quite a bit.
So where are you going to put that money then?
Yeah, I mean, I think, quite frankly, I think the first quarter of this year was all about beta and where could you get upside return. Italy was one, high yield was another, some of the asset-backed markets were another. I think the rest of this year is going to be finding opportunity intra the markets and some rotating across sectors. So one of the things we've done recently is maybe turn back some of the asset classes that are sensitive to growth. So we've taken down a bit of our high yield exposure, gone into some CMBS, sensitive to the commercial real estate, which we like, but a bit more high quality today than we were, say, 3 to 6 months ago.
Okay, very interesting. Rick, thank you so much for being with us
Pleasure.
through this hour. Rick Rieder of BlackRock.